Today, let's take a look at market corrections like we saw last week and what you can do to be better prepared for future market corrections. Hello and welcome back to my channel where we talk about investing, personal finance, and dividends. If you're new here, consider subscribing to my channel and smashing that like button if you enjoyed this type of video. Also, don't forget to follow me on Instagram. Let's get started. Last week, there was a lot of red in the market. Does that indicate there's a crash coming? Should I be worried? Should I take money out of the market? Is everything on sale? Should I buy more? These are some of the type of questions we have been thinking in the past week. We can speculate what's about to come, but no one can really predict the future reliably and consistently. We don't know when that will happen, and we can't really time the market perfectly. But what we can do is be best prepared for when corrections like these happen, expect what's coming, and maybe even make some money. What do we think of when we say market crash? The first one that comes to mind is the stock market crash of 1929, when investors were speculating in the market, and when it looked like it couldn't go any higher, everyone panicked and took all their money out. We did not have any policies protecting an event like that from happening, which caused the stock market to have the biggest crash we've ever seen. Then again in 1974, the market dropped about 40% when the US dollar was taken out of the gold standard, which caused all the prices in the market to collapse. Then the next biggest drop was recorded in 1987, which is referred to as Black Monday, where the market dropped by 22%. Next came the dot-com bubble in 2001, where people were buying all the internet stocks because they thought that was going to be the next boom, but that didn't happen and the internet stocks were actually losing money, causing the market to collapse. The tech sector alone dropped about 70%. The next major crash was in 2008, which is referred to as the Great Recession or the housing market crash, where banks were lending money to everyone, even to those who will not be able to pay them back. Those people couldn't pay back the mortgages, which meant the banks couldn't handle the debt. Homeowners were losing their houses and the whole economy collapsed, and the market dropped by more than 50%. And the final crash was from last year, when the market dropped around 35% from the peak because of the pandemic. It started recovering soon after the crash because of market policies and the government helping to raise the economy. To prevent catastrophic drops in the market, there are extra measures taken by the exchanges. For example, there is a circuit breaker in place, and it gets triggered whenever the S&P 500 index drops by 7%, 13%, and 20%. Once these thresholds are triggered, all trades come to a halt for a certain period of time, giving us enough time to think about what we're just about to do, with the last threshold halting all trades for the rest of the day. There are also measures taken by the government to prevent an economic crash, such as lowering the interest rate, providing stimulus checks and CERB payments to citizens to help boost the economy. The market is volatile and the price drops all the time. It's not necessarily a market crash. That really depends on how much it drops by and how bad it is. According to Fidelity Investments, since the 1920s, the S&P 500 on average drops about 5% 3 times a year, and it drops about 10% every 16 months, and it drops about 20% once every 7 years. When it drops by 5%, it's considered a pullback, and when it drops by 10%, it's considered a market correction, and when it drops by 20%, it's considered a bear market, and when it drops more than 20%, it's considered a market crash. Now that we know price drops happen often and are healthy for the stock market to take a step back and reevaluate the market, what do we need to know about this, and how should we prepare ourselves for the future? Having an emergency fund that covers 3 to 6 months of expenses is very beneficial in situations like these. You will have enough money to hopefully cruise through the entire market correction. In case of an emergency like an unexpected expense or in an event of a job loss, you'll have enough money to take care of all the expenses during tough times. And hopefully you won't have to sell your investments when they're low to pay for stuff, and sail smoothly to get to the other side of the market correction without having to worry about too much. Making sure you have your investments spread across different sectors of the market, aka don't invest in one single company or one single sector. Make sure to invest across multiple different sectors of the market like tech, energy, healthcare, financials, and so on. If we have a diverse portfolio that is spread across multiple different sectors of the market, when one sector of the market takes a hit, our other sectors can make up for it. If they all take a hit, then we should be prepared with some cash on hand that we can put into the market and take advantage of these discounted prices. Which brings me to my next point. It's always a good idea to have some cash on hand. When the market is going through a correction, it allows you to buy additional stocks at lower price, which essentially lowers your average buy price on some of your holdings. If you have cash on hand, you should consider buying more into the market. Not all at once, but pace yourself and dollar cost average into your holdings. We should look at the short-term corrections of the market as opportunities to buy our stocks at a discounted price. Since our strategy is going to be a buy and hold for a long term, our money will grow over time. Don't sell. The stock market is never rational. There are always extreme reactions, like whenever there's any good news, the stock market hikes up like crazy, and whenever there's any bad news, it just crashes down like crazy. And the reasonable value of a stock lies somewhere between those two lines. We shouldn't let our emotions take control over us. If you decide to sell and be out of the market for a couple days, you could potentially lose more than if you just stayed invested in the market. And that is because we can't predict the future. What if the price goes back up as soon as you sell? You could potentially lose more money. Fidelity did a study where if you had $10K invested in the S&P 500 index since 1980 and you never took the money out, your investment would be worth about $700K. If you sold or missed out on the 5 best trading days, your investment would only be worth $432,000, which is $265,000 less. And if you missed out on the best 10 trading days, your investment would have been reduced by more than half, sitting at $313,000, losing you $384,000. If you missed out on the best 30 trading days, you would have missed out on $582,000. And finally, if you missed best 50 trading days, you would have resulted in $649,000 of missed opportunities. Based on the study, it shows that selling your investment because market is dropping or trying to time the market would have resulted you in missing out on huge opportunities in the stock market. It's hard to predict the future. Most of the time, the short-term fluctuations in the market are based on emotions. There's no fundamental change to these companies. Try to get in the market whenever possible, rather than waiting in the sidelines saying, oh, the prices are too high right now, I don't want to buy in. Dollar cost averaging is your friend. You can dollar cost average down into your holdings in the future, instead of trying to time the market perfectly and getting in at the lowest price possible. That might never come. There's a very low chance that you'll time the market just right, because no one can really predict the future. Stock markets are usually priced with the future in mind. So the price going up or down really depends whether we see the company doing well in the near future or not so well. But for long-term investors, the short-term price fluctuation does not matter. We can't let our emotions get the best of us, and we can't let it get in our way of our investments. If we believe in a company and its long-term goals, these market corrections are like a discount on our investments, and we can take advantage of it by buying the dip. My strategy is to just buy more and dollar cost average on my investments. It's going to be worth it in the long run. As always, make your money work for you, not the other way around. You can check out Wealthsimple and start investing today. I have another video that walks you through the setup. I'll leave a referral link in the description box below. If you use that link to sign up, fund your account $100 and buy some stocks with that, you'll receive $10 and I'll receive $25 as well. Let's take personal finance into our own hands and make our money work for us. Make sure to follow me on Instagram, and if you like this video, be sure to smash that like button and hit that subscribe button for more content like this. Bye!